Thanks for tuning in to Talking Point. I'm your host, Neeraj Shah. I think from Yes Bank to Lakshmi Vilas Bank, there are probably lessons that we need to learn from bank failures. What does it mean for the system at large? What does it mean for equity investors in some of these banks, the bank stocks? And I think it's very important to try and figure out how to go about investing in, therefore, in some of these pockets. That aside, we'll also talk to our guest, Dhananjay Sinha, about what is his opinion on markets at large, simply because the last time that we spoke to him, he was one of the rare people who said that the rally in financials would continue. And boy, the bank Nifty's had a breakneck move. So let's talk about all of this and put all of this into perspective with him. Dhananjay, good having you. Thanks so much for joining in. Hope all is safe.
Yeah, thank you very much, Neil.
And
I'm
our pleasure is
delighted.
ours, and wishing you a happy
Yeah,
week.
yeah, same to you.
Okay, Dhananjay, can we start off with the hot potato and then we'll move on to the longer term picture?
Sure.
LVB, what do you make of it? I mean, this is what, the fourth or the fifth instance in the last 2 years that we've seen a bank go under. Uh, what are the lessons to be driven from this? And and anything that you think could have been done differently, so to say.
So I think the LVB, Lakshmi Vilas Bank, saga has been there in front of us for the last 2 3 years. I think there has been a lot of attempts to resurrect the bank. Managements have been changed, and the top level, the heads have been changed, but I think it hasn't really worked out well. And this bank was under prompt corrective action also of the RBI. So I think there was a good amount of tracking that was done by the regulator. But notwithstanding that, it is not really come out. And I think that vulnerability sustained, and with the pandemic hitting in, I think that became even more unviable. So essentially, the bank saw erosion of capital completely. So I think the tier one capital, or CET1 capital, is actually negative. And there has been mounting asset quality issues as well. So I think while this asset quality thing has been there for a while, I think it has actually been rising. So the gross NPA is about 24%, net NPA is roughly about 7%. So there has been provisioning that has been made, but the bank hasn't been growing. So essentially, that's how it has panned out. And I think the smaller banks who haven't been managed so well, also with respect to some of the NBFCs, we have seen such problems occurring over the last 3 4 years. I think especially after I would say 2014 or 2016 onwards, this has been the case. So right now we have come to a situation where it is not sustainable, and there were multiple people who were looking to buy the stake, and it hasn't passed the regulator. So finally they have zeroed in on DBS Bank. And essentially the whole idea, if you look at after the ILFS debacle, I think the regulator and the governments have actually become far more proactive in resurrecting the banking sector, because they know that if they let it linger on, it is only going to create more problems. And we have seen that in the case of ILFS, and then we have seen in the case of Yes Bank how proactive the regulator has.
That's true.
And also other banks were involved in this. So I think what appears to be happening is that the regulator is looking for more enduring solution for such impairments. And I think this particular episode also adds to the series of things that have been happening recently. So I think from that standpoint, I would say that allowing DBS to take over it's a good decision, because DBS is pumping in a good amount of capital. I've heard it's about 2,500 crores or thereabout. Yes. If you remove the net, you still have about 1,600 crores or something. That's about 15% of the 15% capital. So I think you will have, in a situation when DBS comes in, there will be growth capital above the regulatory requirement. And I think DBS, the government, the RBI also wants DBS to expand the business of LBV later on. And we know that DBS has got presence in in digital banking, and they have presence in most of the large cities. So, this bank can become pan-India as well. Subsequently, I think those are the thoughts that might have gone behind this decision.
No, I think this must be the swiftest resolution that we've seen, isn't it? I mean, which
Yes,
shows that
yes.
it was pre-planned. But then there's
Right.
just two quick questions rolled into one. Um,
Sure.
One, for an equity investor,
Sure.
always a case of all, or not always really, but a case of holding left with holding the lemon, so to say. That is part
Right.
one. And part two of the question is, in a lot of cases that we've seen, and I think Ira has written that in our column today, that in some of these cases at least, growth, the trajectory of growth really changed. And should there be some bit of a safeguard arrangement? I'm not saying growth is bad, all growth is good, and some of the high quality
Mhm.
banks also have grown at the breakneck pace. But the common refrain seems to be that here, the trajectory of growth really changed. And you look at all of the cases in the last five, most of them had that. So, is there a way to safeguard against that? And is there a way to safeguard the equity investors' interest? Because the equity investor seems to be holding the bitter end of the stick almost all the time.
Yes. So the thing is, as far as LVB is concerned, I think the situation was evident, I would say, in public domain. So it was all there in the public domain, and hence there was enough information with the investors, be it retail investor or institutional investor, to sort of accommodate that information in the decision making. And and since this was a lingering problem, there was enough time for people to move out. So that is an unfortunate thing for people who have stayed back to actually hold on, and where there is a significant drop in prices. I think today the stock price is down 20% or something. So I think ideally investors should look at, especially in the banking sector, towards large banks, or banks that have got good and strong management, who have got good track record. So that's a general reframe. So if you look at it, the outperformance has also happened in that component of the banking space. And so that is the typically retail investors also look for such high risk bank to make large money during times when it is good, but they end up losing a lot, actually. So I think, as far as banking sector is concerned, one has to be very clear about the quality of management, stability, the quality of book, underwriting capabilities, and I think these things are available if you look at the information. The operating matrix of the banks, all these things are there.
That's true.
So I
Yeah.
think there was enough
Dhananjay, would
time.
you?
Yeah, sure.
No, I'm just wondering. So you are right. There was enough time, and therefore my question is: would you then therefore presume that by natural course the equity investor is the last in the list of recipients, right, of
Sure.
any kind of leftovers? So therefore, it is
Right.
the equity investor's fault, or not fault really, but the equity investor's duty, so to say, to safeguard his or her own interest, because that if indeed there is a case like this, you will be the
Right.
last one holding, and there is no
Right.
no getting around that. Is that a
Right.
is that a fair
Absolutely.
assessment?
Absolutely. 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 So the thing
Okay.
is, if you're holding on, you are telling that you have the appetite to bear that brunt. So that is
Yeah,
what it is.
that's true.
And it is
Okay.
unlike a manufacturing sector company where there are high frequency data on, let's say, how many two-wheelers are sold or four-wheelers are sold. Those things are there. It is not a manufacturing company, and hence we have to rely a lot on the quality of balance sheet, the way the management is actually tackling it. It's far more, I would say, covert, in a sense that it's not very open in terms of the data that comes around, and you have to rely a lot on the management, the quarterly results and stuff.
That's true. But anyway,
Right.
Dhananjay, two other points, and frankly, the banking rally has been just quite stellar. Now,
Sure.
on the day that we spoke, which is a month and a half, 2 months back, I don't quite remember
Right. Right.
exact date,
Right.
but you had mentioned that you believe that the rally would continue, and it has continued.
Sure.
What's your sense
Right.
now? Because the foreign investors' interest is still alive and kicking, but the
Sure.
stocks have really rallied.
So the thing is, when we say it has rallied, it has rallied after declining quite substantially. If you look at the pandemic crisis, again, drawing from an earlier point, that the vulnerability and uncertainty with respect to the BFSI space has been very, very large. Hence, the contraction has also been very steep. And some of the stocks have gone down by almost like 70% in the BFSI space. So I think the rally has also been significant in terms of valuation. Despite the fact that the bank Nifty has rallied about 70 to 70, I would say 74% from the bottom. I think the bank Nifty was somewhere around 16,500 or thereabout at the bottom. Today it's close to 29,000 or something. So the valuation is still fairly low compared to the pre-pandemic level. So if you look at the bank Nifty valuation prior to the pandemic, it was roughly about 3.8 times on a trailing basis. It went down to 1.8 or 1.6, and then currently it's about 2.4 or 2.5. So I would say that it's still fairly lower than what it was earlier on, and hence there is a significant upside still there. So the thing is, what is really happening is that first of all, the concern on asset quality, the impact of the COVID, etc., is far lesser, and we are seeing that in terms of the asset quality guidance that banks are giving. Number one. Number two, I would say compared to earlier crisis, the regulator, including the RBI and the government, have been fairly proactive in providing the forbearance, be it the moratorium 1 and 2, and then restructuring, and then ECLS scheme, which has been extended by the government. So I think all those, the backup that the regulators and the government has given is far more stronger. And then I would say, unlike previous crisis, the financial conditions this time around has been fairly strong, be it the FX flows that we see into our country. Also, if you look at the equity market, the bond market, etc., or the currency market itself, I think it's been fairly orderly. And hence, all that has actually supported the way the banking sector crisis has actually been far lesser. So I think, and the other thing is that because of that, the banks have been able to raise a lot of funds. Banking space, NBFCs also. Hence, the capital buffer is fairly strong. So going forward, the way we are looking at it is that today, if you look at the first 2 quarters, banks have typically been fairly cautious in terms of growing the balance sheet. They have not really lent enough. They have invested a lot. The deposit increment that has happened has been invested largely in liquid assets, treasury, instruments or short-term money market instruments, and hence they have compromised on the asset growth, being overly overweight on liquidity preference. So I think going forward, this will unwind because they have the capital. They have compromised on the spread that is available today. If you look at the private sector banks, the spread between the average lending rate and the average cost of fund is almost like 520 basis points. 520 basis points, which is highest in 20 years. So essentially, the way it will pan out is that banks will start leveraging the excess capital buffer that they have because they need to increase the return ratios. They need to move away from liquidity preference to earning yields. Hence, they would move towards more aggressive lending than what we have seen today. We have seen some semblance of that in the way the credit spreads in the bond markets are actually compressed, be it AAA paper, corporate papers, or AA plus paper, or even lower quality paper. The spreads have actually come down. So my sense is that in the appetite for risk taking in the banks is emerging, and all these things are evident from the guidance that most of the banks have given in the Q2 results. So second half, most of the guys are telling that there will be better growth. Our own forecast has been that bank lending growth will be about 7 to 8% by year end FY21, and then grow up further to about 15% next year. So essentially, you will have a significant operating leverage happening next year. Asset quality concerns are there, but I think as the rest of the balance sheet grows, I think that will start dwarfing. And hence, I would say that valuation, juice is still there, I would say. And when we targeted 32,000 for Bank Nifty about 5-6 months back, that was the time when nobody thought about it. Today, it is very much near. We are just about 8% lower than that. My sense is that that level also was sort of based on a conservative projection on valuation. So we thought of 2.6 times multiple price to book on a trailing basis to arrive at that. And today, if I look at it, there will be this has to be revised. Our model estimate was about 3 times. Now,
Right.
and it could go even higher. So I'm saying that from here on also, as the operating leverage kicks in, and the profit growth starts to rise, and banks start to lend more, the appetite for investors in the banking space will increase significantly. Right now, if you go back 2 months back, it was a consensus short in most of the funds, including mutual funds and FIs. All of them were selling banks, and they were actually, and banks in general, in specific, and BFSIs in general. They moved significantly overweight on pharma, FMCG, Reliance, and those kind of stuff. So what is now will happen is that this will normalize to more cyclical stocks. So banking being the first in the order. So what you see today is FIIs coming back. Right now, you have FII flows of roughly about $15 billion in equities, and the under ownership of banks is actually normalizing. What hasn't happened yet is the mutual fund side is still underweight. They have not really normalized. So the next leg will be a compounded impact of FII buying into banks and the BFSI space in general, and then that adds and it gets compounded with the participation of the mutual funds as well. So I think there is both from a fundamental standpoint, the cyclical standpoint, and also the flow standpoint, I think there is a significant upside remaining, and I think from a ballpoint estimate standpoint, I think it will be roughly about 40,000 for Bank Nifty versus our earlier conservative target of 32,000.
Wow. Okay. Well, that's a bullish Dhananjay Sinha on banks, and if banks do well, there is no reason that the Nifty would not. I just reckon what will compensate for that then, Dhananjay? Because I'm guessing the upsides that you see in the Bank Nifty, you don't quite see in the Nifty, right? Yes, you see upsides, but not of the same quantum. So therefore, do you think some of the heavyweights would underperform? Would it be IT and pharma which will underperform? Would it be Reliance that will underperform?
Yes. So as I said that, our theme has been sector rotation for the last, I would say, 5-6 months. And since that time, we have been sort of saying that one should actually go towards sector rotation. And hence our preference has been BFSI and metals. And then we are moving into other deep cyclicals as well. So I think gradually construction, real estate, etc. also will start participating. So I think what will happen is that people who have this whole consensus overweight on FMCG, on let's say pharma, Reliance, or other kinds of several other sectors, that will actually sort of realign in a sense that investors will start looking at cyclicals more seriously. So I would say in the cyclicals, I would also include mid-cap space as well. So I think mid-cap also should start doing that.
Okay. Dhananjay, so just try to understand, when you're talking about relative underperformance in IT, would you believe that the heavyweights, the likes of TCS, Infosys, etc., will underperform, and maybe heavyweights on the banking side, which are already knocking at 52-week highs or more, or life highs in the case of HDFC Bank and Kotak, you think those names will outperform the heavies in the IT space?
Yes. That's precisely what I'm telling. Yeah.
Okay, great. Now, when we talk about cyclicals, it's a very wide basket. And I think the last 2 days, the trading behavior suggests that the market breadth is positive because those sectors are a lot more widespread than the narrowness in pharma and IT.
Right.
What do you think is fundamentally aligned to perform well? Because we've seen real estate sales, for example, show a big positive surprise in the quarter gone by. Do you reckon real estate companies, for example, could actually show a dramatic upswing? And again, out there, would the high quality ones take the stage, or do you think the whole wide bucket will move up?
So I think there has been a lot of focus of the government and RBI as well through the various measures that they have taken, which supports the real estate sector, and also the government also sort of doing a bit of it to revive the affordable housing space. So I think there will be a sort of a general focus on the real estate sector, and I think gradually the purchasing will start improving because the prices also have sort of corrected because of the shock. I think so that will sort of emerge. So I think the way to really look at is that if the real estate sector and also if the construction activities improve, as has been the intent of the government with respect to the additional stimulus that it has provided. I think a good way to really play that is through the material space, which includes steel and cement. So I think steel and cement can be a sort of a good play from a housing standpoint. But I would say that if you look at the listed space in the realty sector, I think the larger players are better placed to really gain there because I think gradually the urban side, urban economy is also expected to revive. Up until now, we have seen the rural sector being fairly resilient and being strong. I think the focus now is shifting towards revival in the urban economy. I think all the measures that the government announced prior to the Diwali, the Diwali package, the pre-Diwali package, I think the intent is fairly clear. So I think the revival and I think with respect to job losses, etc., in the urban space, especially the organized sector, hasn't seen that much of a sort of contraction. And I think more than the loss, I think there was a sort of a fear factor that was playing up in the urban area. So I think those are sort of reviving with revival in consumer confidence. So I think with that, I think the pent up demand for real estate might actually start reviving, and with the banks and lenders being fairly proactive in pushing mortgage lending, as we are seeing the retail lending is actually picking up, not just for durables and other consumption items, but also for real estate, which is mortgage lending is a very large, I would say 50-60% of the retail lending. I think there might be revival in the real estate as well. So I think large listed space can actually do well, guys who have got good presence in larger cities. Yeah.
Well, as we speak, I think I'm just reading out that I think L&T has been awarded a very large order for a construction and mining equipment business. I think it says that the flash seems to suggest that it's the biggest order ever for the construction and the mining equipment business. Ties in with what you were just saying, and
right,
utilities.
Yeah, absolutely.
Again, out here, do you think the larger ones will benefit, or some of the mid-sized ones could also gain?
I mean, there's no denial that there will be a sort of trickle-down effect. So if L&T does a large amount of large contract, it subcontracts as well. So there will be sort of a trickling down as well. But from a stock standpoint, I would say I would rather want to buy L&T, which is the dominant player in the space. So I think look at those stocks, which can benefit in the immediate term, and it's fairly visible. And the fact that it is fairly diversified, it will be able to sort of capture more orders going forward as well. It's only when the cycle matures that the rest of the guys start getting abundant orders. So right now, I would say larger companies would benefit more in the initial part of the cycle.
Okay. We'll also get you, viewers, a slice of Dhananjay Sinha's top ideas as well on the graphic plate in just a moment. But just before that, Dhananjay, one quick question. If indeed there is going to be a sector rotation, what about one sector wherein your analyst team seems to be bullish and which has already done well, which is specialty chemicals? What's your sense there? Because there, the things seem to be slightly different. When I read the notes from Systematics as well, they seem to be fairly optimistic about the commentary given by the managements as well as the earnings growth potential. What's your view there? And what do you like there?
So the thing is, the specialty chemical is something that we have been fairly positive about right from the beginning. So Deepak Nitrate, Navin Fluorine, those kind of names have been there. So those have actually done very well. So I think the big issue over there has been also the structural part, wherein I think the problems in China has actually benefited a lot of specialty chemicals name here as well, and there has been expansion in capacities. So all those have actually been supporting the specialty chemical names. I think incrementally, I would say that incremental gains from these sectors or these stocks can be limited, because I think this concern on China may be ebbing, according to me, going forward. So I think people would, and the stocks have done phenomenally well compared to, I mean, many of these are significantly above the pre-COVID level. So I think people might actually shift to other components in the mid-cap space. So that's how I would consider the view.
Okay, Dhananjay, before we let you go, and we'll get in that whole data of your ideas, but before we let you go, what is your top bet? I mean, from the conversation, it seems that you are very bullish on banking, but
Sure.
from an alpha perspective, would it be banking which will stand out, or could there be some other pocket, however small it may be, real estate, construction, metals, what have you? What is your top bet?
So I would say that banking is still a fairly good place to be in. If I have to really look at 1 year down the line, so I would say, yeah. So while our top picks in terms of banks have been up till now, HDFC, ICICI Bank, and Kotak Mahindra Bank, but we think that incrementally, as things would pan out, banks with high credit risk might start outperforming. So Axis Bank, IndusInd, RBL, especially with the extension of the ECLGS scheme, there will be they will see greater gains. So I think the alpha can actually come from there. And then I would say even in the NBFC space, there is traction that is happening, be it Bajaj or Cholamandalam or I would say Shriram Transport. So Shriram Transport essentially linked to our theme on commercial vehicles. So there has been a revival in the commercial vehicle space, and I think the lenders can actually gain out of that. Cholamandalam and Shriram have significant presence there. Shriram is in the second-hand vehicles, as you know. So there, I think there can be a sort of alpha there as well. And I would say in the auto space, our picks has been Tata Motors, Maruti, Eicher Motors. But I think gradually, as the commercial vehicle starts to see a revival because of better availability of freight and also increase in freight rates, there can be a sort of spillover effect for Ashok Leyland, Tata Motors and Bharat Forge in the ancillary space. So I think that's the auto space. We have been fairly bullish on metals, for instance. So JSW Steel and Hindalco are the top picks out there. So I think those are the things, and we talked about specialty chemicals as well. I think those are the names that are there in our list.
Okay, Dhananjay, great calling, especially during the tough times. Maybe the times are tougher now because the markets have rallied so much. So it'll be interesting to see how they shape up. But it'll be lovely talking to you once again in the new year. For now, though, thank you so much for speaking to us today. And
Thank you very much. Yeah,
the pleasure is ours. And viewers, this is coming from somebody who identified it very correctly about a couple of months back that BFSI and Bank Nifty could be in for a very good rally. It's rallied really well since then. He now says that maybe Bank Nifty could have a target of close to 48,000 as well. Let's wait and watch how that shapes up. Banking remains the top draw, but some of the others like construction, engineering, and specialty chemicals also stay at the forefront. Thanks so much for tuning in to this edition of The Talking Point.